65% of Americans are currently living paycheck to paycheck, and that includes a substantial portion of people earning over $100,000 a year. A Schwab survey found that six-figure earners carry an average credit card balance of nearly $8,000. But here's the thing nobody tells you about that statistic. The people who escaped that cycle didn't do it by earning more. They did it by setting up a specific 4-part automated system that takes about 45 minutes to configure and then runs forever without you touching it. I'm going to give you the exact architecture of that system today, with real numbers, real math, and the behavioral science that explains why every other approach you've tried probably failed. And I want to be clear about what this video is not. It is not a budgeting lecture. It is not a cut your coffee argument. It is not a motivational speech about discipline and delayed gratification. This is a systems engineering problem, and I'm going to treat it like one. Because the reason most people stay financially stuck has almost nothing to do with their income level and almost everything to do with how their money moves, or more accurately, how it gets intercepted before they ever have a chance to direct it anywhere useful. But before I get into the system itself, I want to tell you something that reframes this entire conversation. Something that took me years of running my own business, sitting in rooms with accountants and tax lawyers, and having multiple hundreds of thousands of dollars in the market to fully understand the financial industry has a structural incentive to make this complicated. Complicated means you need advisors. Advisors charge fees. Fees compound against you. Keeping it simple is, in a very literal sense, their single greatest competitive threat. So let's keep it simple. By the way, I built a free early retirement calculator because most of the ones you'll find online are mathematically wrong, they assume linear growth, they ignore fee drag, they don't model inflation erosion. Mine uses the same methodology embedded in BlackRock and Vanguard's internal planning tools to expose the weak points in your current plan. I only ask for your email to send the report. I don't store any of your financial data. Link is in the description. Now, I want to give this video one frame, one metaphor. Hold on to it, because we're going to come back to it every few minutes. And by the end, it's going to feel less like a metaphor and more like a diagnosis. Most people carry buckets. They fill the bucket with their paycheck. They carry it across town, rent over here, car payment there, groceries and utilities, and streaming subscriptions draining from the bottom before they even get home. By the end of the month, the bucket is empty. They go back and fill it again. Same weight, same route. Same empty bucket at the end of every month for decades, until something, a medical bill, a car repair, a layoff, finally breaks them. Wealthy people don't carry buckets. They build pipes. A pipe is a system. You design it once. You connect it to the right sources. And from that point forward, the water flows without you lifting a finger. You can be asleep on a beach, arguing with a contractor about tile work, or doing absolutely nothing useful, and the pipe keeps running. The bucket people look at the pipe people and assume they got lucky, that someone handed them a better starting position, a richer family, a better job. But the pipes aren't a gift, they're a decision. A decision you can make this week. Every single piece of advice in this video maps back to one question. Are you building a pipe right now, or are you shopping for a lighter bucket? In a few minutes, I'm going to show you the most expensive financial mistake that otherwise intelligent, hardworking people make, and I'll tell you up front, it has nothing to do with overspending. It's something structural, something quiet, and by the time most people identify it, they forfeited a decade of compounding they will never get back. But first, let me explain why the income illusion is the thing that keeps ambitious people stuck the longest. Because it's the trap that ensnared almost everyone I know who struggled with money despite earning a solid wage. There was a man named Richard. He spent his entire working career believing that income was wealth. He worked in supply chain management at a Midwestern manufacturing firm. And by his late 30s, he was earning just over $100,000 a year, a number he chased for nearly a decade. When he finally crossed it, he and his wife went out to celebrate. They moved to a nicer neighborhood, leased a better car, renovated the kitchen, and his lifestyle expanded quietly, automatically, the way gas expands to fill whatever container you put it in to consume every single dollar his income gained. 22 years later, when his company was acquired and he was offered severance, Richard discovered something that he described to a mutual friend as the most clarifying and most devastating moment of his financial life. He had approximately $22,000 in liquid savings. His retirement account, underfunded and barely touched for 15 years, held about $61,000. After 2 decades of earning more than most Americans will ever earn in a year, his net worth sat at roughly $83,000. Everything else had been spent. Not on anything dramatic, on life. The version of life that grew every time his income did. Richard is not a cautionary tale about irresponsible people. Richard is a cautionary tale about a fundamentally broken mental model, one that the entire consumer economy is designed to reinforce. Here is that model. Most people believe income equals wealth. It does not. Income is a cash flow event. The moment your paycheck clears, every company in America, your landlord, your car manufacturer, your insurance company, your credit card issuer, your subscription services has an automated system designed to intercept as much of it as possible before you do anything useful with it. They have pipes. Their pipes drain your bucket before you have a chance to build your own. You think the problem is you're not earning enough, but actually, the problem is you're not converting enough of what you earn into things that generate value without your labor attached. Income is what you trade your time for. The moment you stop showing up, the income stops too. An asset, an index fund, a piece of real estate, a business stake keeps generating value whether you're in the building or not. Jeff Bezos did not get wealthy because Amazon paid him an extraordinary salary. He got wealthy because he owned a piece of something that grew independently of his personal labor. That is the entire game. And it is available through automated transfers and a basic brokerage account to anyone willing to understand the mechanics. This brings me to the framework. I'm calling it the 2010-60-10 system. It is not complicated. Versions of it have existed in personal finance literature for decades. What is new, or at least criminally underappreciated, is the automation layer that makes it work in practice for real people who are not naturally monastic about money, which is to say, for people who are human beings. 20% of your take-home income goes to growth. 10% goes to protection. 60% covers your actual life. 10% you spend guilt-free on whatever you want. 4 pipes, set up once, running forever. The bucket people will read that and say it sounds too simple, which is correct. Simple works. Complicated is how your bank makes its margins. Now, here's something that took me an embarrassingly long time to fully understand about why discipline-based approaches fail, and it comes from behavioral economics, not finance. In 2017, Richard Thaler won the Nobel Prize in economics, not for discovering a new financial instrument, not for a new market theory, but for systematically documenting how human beings make predictably irrational financial decisions. One of his foundational findings was something called mental accounting, the phenomenon where people treat identical dollars differently based on how those dollars are categorized. The money in your checking account feels different from the money in your savings account, even though a dollar is a dollar. The bonus check feels different from the regular paycheck. And critically, money that hasn't been mentally assigned a job yet is available for impulse. Budget systems fail because they require you to make the right decision repeatedly, daily, under varying emotional conditions, against a backdrop of trillion-dollar marketing infrastructure, specifically engineered to extract money from you with maximum psychological efficiency. That is a losing proposition by design. The 2010-60-10 system doesn't ask you to make the right decision every day. It asks you to make the right decision once the day you set it up, and then execute it automatically, indefinitely, without requiring any additional willpower from you ever again. The money moves before you see it, before your brain assigns it a purpose, before the rent anxiety and the grocery list and the Amazon algorithm have a chance to stake their claims. You pay your future self first. Everyone else gets what remains. That is the pipe. By the way, hit subscribe if you're finding this useful. YouTube's algorithm may genuinely never surface my videos again if you don't. This isn't filler. The algorithm rewards clear engagement signals, and a subscription is one of them. Subscribe. Let me now walk you through each pipe with actual specificity, because general advice is how you end up with a Pinterest board of financial quotes and still no index fund. The 20% growth pipe is where wealth gets built. 90% of this allocation, for most people, should go into broad market, low-cost index funds. Specifically, total market ETFs or S&P 500 index funds from Vanguard, Fidelity, or Schwab. These instruments charge expense ratios of between 3 and 5 basis points. That's 0.03% per year. Your actively managed mutual fund, the one the bank recommended, charges somewhere between 1 and 1.5%. The difference sounds invisible. It is not. Here's a number that should permanently alter your relationship with every wealth manager at a major brokerage. If you invest $200,000 over 30 years in a fund charging 1% annually in fees, you lose approximately $375,000 in foregone compounding compared to a fund charging 0.03%, not $375,000 in fees paid. $375,000 in the compounding that those fee dollars would have generated had they remained invested and working. Your managed fund costs you $375,000 over a lifetime of investing. And statistically speaking, it has less than a 30% chance of outperforming the index it's supposedly beating. I find this genuinely funny. In a specific, theatrical, almost appreciative way. You are paying someone an enormous sum of money for the privilege of probably receiving worse returns than you'd get from automating a monthly purchase into a fund that buys the entire market. That is the financial services industry in one sentence. And their offices are very nice. There's a story that circulates in investing circles attributed loosely to Fidelity, though the firm has never officially confirmed the study that when analysts looked at which customer accounts produced the best returns over time, the answer was accounts owned by people who were either deceased or had genuinely forgotten the account existed. The people who could not interfere outperformed the people who actively managed their positions. I can't point you to a published Fidelity document confirming this. What I can tell you is that the S&P 500 has returned an average of roughly 10% annually over the last 50 years, and the average individual investor has captured about 6% of that over the same period because they kept moving in and out at the wrong times. The pipe outperforms the bucket carrier every single time because the pipe doesn't panic. The second component of the growth pipe is the one that finance media almost never discusses because there is no commission attached to it and no ticker to track. Investing in yourself, specifically in skills that scale your earning capacity. A $2,000 negotiation course that helps you capture an additional $15,000 in annual compensation is a 750% return in year one. No index fund does that. No stock does that reliably. And unlike a stock position, this asset cannot drop to zero because the market experienced a bad quarter. The third component, REITs, individual equities, real estate exposure, comes after the first two are established, not before. Level 1 and Level 2 need to be running before you go near Level 3. Level 3 is where people get excited, skip straight to it, and end up with a Robinhood account full of speculative positions and no emergency fund. I've watched it happen. It's not a pretty picture. Now, I want to introduce you to someone because his story runs through the rest of this video like a thread. His name is Marcus. Marcus was 42, living in Atlanta, working in the events industry. Starting in his mid-30s, he'd done something most people haven't. He set up automatic monthly contributions into an index fund and kept them running. By February of 2020, after roughly 5 years of consistent contributions, he had built approximately $87,000 in that account. This was a real achievement. Then the pandemic destroyed the events industry in about 6 weeks. His income fell by 70%. He had no emergency fund, no protection pipe. He needed cash immediately. And in March of 2020, with markets down 34% from their February high, Marcus liquidated $50,000 of his index fund positions. He had no other option. The S&P 500 recovered its pre-crash level by August of that year. By December, it was up 16% from its February peak. The $50,000 Marcus sold at the bottom, for which he received approximately $33,000, would have been worth $82,000 6 months later. A $49,000 mistake. Not because Marcus made a bad investment decision, because he had no protection pipe and was forced to drain his growth pipe during a crisis at the worst possible moment. This is where it gets really interesting, because most people think emergency funds are for people who are bad with money. That is exactly backwards. Emergency funds are for people who are good at building wealth and want to protect it from the inevitable moments when life stops being theoretical. Your protection pipe target is 5 to 6 times your monthly essential expenses. Add your rent, utilities, groceries, insurance, and minimum debt payments. Multiply by 5, that is your minimum target. It sits in a high-yield savings account, nothing more exotic, and it does exactly one thing: ensures you never become Marcus. When markets fell 20% in 2022, and every financial outlet spent 4 months predicting economic catastrophe, I didn't touch my index fund positions. Not because I'm particularly stoic, because I had a protection pipe covering emergencies, and the emergency pipe wasn't the growth pipe. The separation is the entire mechanism. You don't liquidate your future under duress when you have a designated fund for duress. The protection pipe returns nothing dramatic, 4, maybe 4.5% in a high-yield savings account right now. And it is the single most important financial structure you can build, because without it, every other pipe is one crisis away from being dismantled at exactly the wrong time. Now, stay with me, because this next part changes everything. We've talked about building wealth. We've talked about protecting it. What silently destroys it in ways that don't feel like destruction while they're happening is what I need to address next. And it has a very sneaky accomplice. Lifestyle inflation is not a personal failure. It's a documented psychological mechanism called hedonic adaptation, the human tendency to return to a relatively stable baseline of satisfaction regardless of what changes in external circumstances. You get a raise. For about 6 weeks, you feel genuinely, almost exuberantly wealthy. Then your brain recalibrates. Your lifestyle expands to match the new income. And you're back to the same emotional relationship with money you had before, just with a bigger apartment, a nicer car, and somehow still the same underlying anxiety. The consumer economy is specifically engineered to exploit this cycle. Every upgrade triggers a new baseline. The new baseline requires a new income to sustain. The gap between your income and your actual financial progress stays exactly where it always was, just denominated in larger numbers. Let me be specific about what this looks like in a real person's life. If you earn $5,000 per month take home, your 60% life pipe cap is $3,000. Rent at $1,900. Car payment at $490 on a recently financed vehicle. Utilities at $180. Groceries at $380. Health insurance and copays averaged monthly at $190. That's $3,140. $140 over your cap, before your phone bill, before gas, before anything unexpected happens. You're not financially stuck because you're irresponsible. You're stuck because your fixed costs consumed the oxygen before you had a chance to breathe. And fixed costs are the cruelest form of lifestyle inflation because they're invisible. They don't feel like spending. They feel like obligations. Here's what I want you to understand about the 2 biggest fixed cost categories: housing and transportation. These are where emotional decisions disguise themselves as rational ones most convincingly. You didn't need the bigger apartment. You needed to feel like you were succeeding. You didn't need the new truck. You needed your colleagues to register you as someone who had arrived. Thorstein Veblen described this in 1899 conspicuous consumption, the practice of spending on visible, expensive things to signal social status. That was 126 years ago. The products have changed. The impulse has not moved a single inch. And here's where I want to briefly acknowledge something, the voice in your head that just said, but the financial advisor at my bank told me I needed a diversified, active management strategy for long-term growth. That person said that from an office he doesn't own, on the way to a lunch he expensed to a management fee you paid. He's not your enemy. He's just operating on a completely different set of incentives than yours. His pipe runs on your fees. Understanding that isn't paranoia, it's how institutions work. The car math is not subtle. A $12,000 reliable used vehicle costs $12,000 plus maintenance. A $40,000 financed SUV at the auto loan rates available in early 2026, 7 to 8% on new vehicles, costs approximately $49,000 over a 60-month term in total payments. At the end of those 5 years, the vehicle is worth roughly $18,000 to $20,000 due to depreciation. You paid $49,000 for something worth $20,000. The $29,000 delta went to the bank into their pipe. The financial industry runs on the gap between what people spend and what things are actually worth. And here is the compounding cost of that car decision specifically. The $500 a month you're spending on that payment, invested instead into an index fund, averaging 7% annually over 10 years, grows to approximately $86,000. You are not choosing between a nice car and a boring car. You are choosing between a depreciating asset and $86,000. That is the real trade-off. It almost never gets framed that way. The early compounding math is even more brutal. A person who invests $500 a month, starting at age 25, and stops completely at 35 10 years of contributions, $60,000 total invested, will have approximately $875,000 by age 65, assuming 8% annual returns. The person who waits until 35 and then contributes $500 monthly for 30 consecutive years, $180,000 total invested, 3 times as much, will have approximately $680,000. The person who invested less than a third as much money ends up nearly $200,000 ahead. That is not a typo. That is compound interest doing things that human intuition genuinely cannot track. And every year you delay starting the growth pipe, that gap widens in the wrong direction. But here is what the deprivation-based financial advice crowd gets persistently wrong about cutting lifestyle costs. If you slash every discretionary expense to its minimum in pursuit of maximum savings rate, you will sustain it for approximately 4 months. Then you'll spend a week in what can only be described as a consumer event, buying back everything you denied yourself, and you'll feel like you failed. You haven't failed. You've asked willpower to do a job that system design was built for. Willpower is a finite resource. Systems are not, which is exactly why the fourth pipe matters more than most people credit it. 10%, guilt-free, a separate account with a debit card linked to it. Spend every dollar of it every month on whatever you want with zero justification required. Concerts, restaurants, a weekend somewhere, something frivolous and fun. This is not a reward for good behavior. It is a structural sustainability component. Without it, the system creates resentment. Resentment destroys systems. A broken system at month 5 is financially catastrophic compared to the cost of 10% of your income deployed on enjoyment. Research from Thomas Gilovich and his colleagues at Cornell, who have spent over 2 decades studying experiential versus material consumption, consistently finds that experiences produce greater long-term happiness than objects. The dopamine response from buying something new fades within days, sometimes hours. The pleasure derived from an experience, a dinner, a concert, a trip, actually increases over time as it becomes a memory, a story, a thing you reference about yourself. You're not spending money on a nice dinner. You're manufacturing something that compounds emotionally for the next 10 years. On a per enjoyment hour basis, that is a genuinely efficient deployment of capital. And here's the behavioral bonus nobody talks about. When you know you have 10% allocated purely for enjoyment, the compensatory spending stops. The impulse buy at 11 at night because you feel deprived, gone. The purchase you can't quite explain the next morning, gone. The guilt-free allocation makes you more intentional with money overall, not less, because you're operating from a designed abundance rather than a suppressed scarcity. Now let me make this concrete. Let me give you a real person with real numbers. Daniel is 38 years old. He manages projects at a technology consulting firm in Denver. He earns $78,000 a year, approximately $5,300 a month after federal and state taxes, and his current 3% 401k contribution, he has $11,000 in his retirement account, about $4,000 in savings. 18 months into a car lease on a vehicle he mostly drives to the office 3 days a week. He's been intending to get serious about money for approximately 4 years. He hasn't. On a Wednesday evening, Daniel sits down and sets up his 4 pipes. It takes him 45 minutes, including reading the confirmation email from his brokerage. 20% growth pipe, $1,060 per month, auto-transferred to a Fidelity brokerage account the morning after his paycheck clears. He sets up a recurring automatic purchase of $900 into Fidelity's zero total market index. Fund expense ratio is literally 0% and $160 into a REIT ETF for real estate. Exposure without being a landlord. 10% protection pipe, $530 per month, auto-transferred to a high-yield savings account currently yielding 4.3% APY. His target is $15,000, 6 months of essential expenses. He hits it in 28 months, 60% life pipe, $3,180. Doing this calculation for the first time, Daniel realizes his rent at $1,800 and his lease payment at $420 already represent 41% of his take-home income. Not catastrophic, but it leaves almost nothing in the remaining 19% for food, utilities, and insurance. He makes 2 concrete decisions. When his lease expires in 15 months, he does not renew it and buys a used Honda CR-V for around $13,000 cash using savings he'll build in the interim. And immediately, this week, he cancels 2 streaming services. He opens approximately twice a month, renegotiates his phone plan, and starts bringing lunch on Tuesdays and Thursdays. He recovers $190 a month within the first week with no meaningful change to his quality of life. 10% guilt-free pipe, $530. He opens a separate checking account, gets a debit card attached to it, and makes a commitment to spend the entire allocation every single month. First week, he buys a concert ticket for a show he's been meaning to see for 2 years. He feels, for the first time in recent memory, no guilt about it, because the ticket came from the right pipe. End of year 1. Daniel has contributed $12,720 to his growth account. With average market returns, that account holds approximately $13,300. His protection fund has $6,360 building toward $15,000. He also finally optimized his 401k contribution to capture his full employer match $2,650 that was previously evaporating unclaimed every year. His total net worth increased by roughly $22,000 in 12 months. Same salary, no side hustle, no windfall, no crypto. 4 pipes in 45 minutes on a Wednesday evening. By year 5, at 7% average annual returns with consistent contributions, his growth account crosses $90,000. By year 15, he's looking at over $280,000 in investment accounts. And by that point, the compounding has a momentum that feels genuinely irreversible. Not because he got lucky, because the pipes kept running while he lived his life. That is the shift. Not from poor to rich overnight, from the kind of person money happens to the kind of person money works for. From carrying buckets to owning pipes. Here are the 3 things I want you to do before this video is finished. First, take your monthly take-home income right now and multiply it by 0.2, 0.1, 0.6, and 0.1. Write those 4 numbers down on paper physically, not in your phone's notes app, not in a spreadsheet. Research from behavioral psychology suggests that the physical act of writing financial targets dramatically increases follow-through compared to digital recording. Those 4 numbers are not aspirational targets. They're operational specifications. They're the architecture of your system starting now. Second, open a separate high-yield savings account today. Marcus by Goldman Sachs, Ally Bank, SoFi, they're all offering competitive rates. Name the account Protection. Set up an automatic transfer for your next payday. The amount almost doesn't matter to start. $50, $100. The pipe is the point. Once the pipe exists, you scale it. You cannot scale something that doesn't exist. Third, identify the single largest fixed cost in your life that violates your 60% cap and assign it a date, not a vague intention, a calendar date. My lease expires in 14 months. I am not renewing at this payment level. My apartment lease ends in July. I am moving somewhere $200 cheaper. One decision, one date. The system handles everything downstream from that decision automatically. Marcus rebuilt everything. By 2023, his protection fund held $18,000, fully rebuilt from zero. During the 2022 market correction, when the S&P fell 20% over the course of roughly 9 months, and every financial news program was conducting what appeared to be competitive apocalypse coverage, Marcus held every single position, did not sell a share. The emergency fund wasn't money sitting idle. It was the reason he could be patient when patience was the only investment strategy that mattered. He told me the emergency fund wasn't really money. It was courage. The structural courage to hold when holding felt difficult. And that courage paid for itself many times over. The bucket people are still out there, carrying the same buckets, running the same route, ending the month the same way they ended last month and the month before that. They're not bad with money. They just never built the pipes. And nobody in the consumer economy has any incentive to help them do it because pipe builders stop being profitable customers. Lazy investing built more fortune than crypto memes. The people who built real, durable wealth, the kind that survives recessions and rate hikes and pandemics and the full catastrophic circus of modern economic life, did not do it through excitement. They did it through systems, through boring, automatic, monthly transfers into diversified funds that nobody was writing breathless headlines about. They did it by setting up the pipes and then, crucially, staying out of the way. You now know how to build the pipes. The only question left is whether you actually build them or go back to carrying the bucket.